Do you have a limited company which you have put money into? If so, you could be missing out on some fabulous tax-free income. Watch this video to understand how. Hi, my name is Simon Misiewicz from Optimize Accountants, and I'm here to help you as a buy-to-let property investor to make more money out of your limited company. Now, before I go any further, I want to explain if you're looking for a video to help you understand should you use a limited company because of Section 24 or other things that's going in your mind, then please watch this video. And equally, if you're looking for a video to help you understand how to extract money out of a limited company, other than interest, which I'm going to talk to you shortly about, then make sure that you watch this video here. Because right now, I want you to stay tuned because I want you to realize that if you have put money inside your limited company, you could be getting some tax-free income out of it. That's right, tax-free income, which you can get out of your limited company. So let me explain how this might happen. You might have a property that you're buying inside your limited company for £100,000. And if you're lucky, like most buy-to-let landlords, you can get a 75% mortgage, which means that you're getting £75,000. But what about the other £25,000 that you need to buy that property? Well, you may have money that's sitting inside your savings bank account, which is, well, is getting a fabulous 1% interest. Woohoo! So you want to make that money work harder for you, and that's why you're investing in property. So your limited company may be asking you to loan it this £25,000. Why is that important? Well, that £25,000 that you've just loaned this limited company, allowing it to buy that property, is now a debt. And that debt can be taken out of the limited company when it's got its money inside it again and pass that money back to you, £25,000, tax-free, because it is a debt, it's not taxable income. So, before we move on any further, have you got a direct loan account which is represented in this way, where you have put money inside of a limited company? If so, please, please, please feel free to drop a comment below to say how much you've transferred to that limited company and what was the reason. And did you have a loan agreement between you and the limited company? Please type that in and I'll be happy to read your comments. Okay, so let's move on. So you might have just heard me say loan agreement. Well, what I'm going to do for you, I'm going to put a link just below here that allows you to say, hey, limited company. By the way, you probably won't be talking to your limited company, otherwise you might be locked up and then sent far, far away. But imagine that you did have your limited company, you would have a loan agreement with it, and I'm going to give you that loan agreement absolutely free. There's a link below this video, so feel free to download that Dropbox link and use that as a loan agreement between you and the limited company. I will specify how much money you're loaning to it, what's the term and conditions, and the interest rate that you're going to charge. Okay, so now we've gone over the legalities here. Let's imagine you've got this £25,000. Now, how much interest can you charge your limited company? Well, I always believe that it's got to be an arm's length transaction. That almost sounds like a trombone. Arm's length transaction. And the reason for that is because you want to be on the right side of HMRC. I bet you want to sleep well at night. And this is why I'm saying maybe looking at the level of interest between 1% and 8% is probably the maximum that I would charge to your limited company. Now, let's think about this. We've got this £25,000 loan sitting up here, and you want to charge it interest. Now, let's imagine that you decide, well, 4% interest is about right for me. I don't need to charge it anymore. The beauty thing about this is that it could be tax-free income. Let me restate, tax-free income to you as a landlord property investor. I was so excited then. I did a mini jump. I don't know if you saw that. But it's ultimately ways of you getting money outside of a limited company. The company now has a charge of this interest that you're charging it, which will help it to reduce tax, and you get it tax free. So let's just go through some legislation points here. The government a couple of years ago said if you are a basic rate taxpayer, you can earn up to £1,000 worth of interest tax free. And if you're a high rate taxpayer, you can earn up to £500 of interest tax free. So we should be using this vehicle to earn money tax free, shouldn't we? So let's have a look at this situation. You've got this £25,000 worth of loan that you're giving to the company. You're going to charge it around about 4 or 5%. Let's imagine that you've now got an interest charge to the company of £1,000. That £1,000 is a cost to the company, so it does get the tax relief, corporation tax relief. And if you're watching this video before April 2020, it will be able to get a 19% tax reducer. And after that date of April 2020, it can get a 17% tax relief on the interest that you're charging it. So happy days. But let's imagine now the money's been transferred to you. Well, I've already said if you're a basic rate taxpayer, that £1,000 worth of interest will be yours tax free. If you're a high rate taxpayer, though, you will be able to get £1,000, which we've said already, but you will only be able to get £500 of that tax free, and you would then have a 40% tax charge on the remaining amount. Now, with every upside with HMRC, there's always some sort of downside, and this is called the CT61, which probably doesn't say anything to you, but CT61 is a form that you need to fill in when a limited company is paying interest to an individual. Now, a caveat to this, if you've got one limited company loaning money to another limited company and there's interest being charged, there is no need to do a CT61. This CT61 form only needs to be done, which you can see there, by the way, what CT61 form looks like, only needs to be done where you've got an individual being paid interest from your company, which is what this scenario will be. So what will happen is this £1,000 worth of interest will be paid to you, but it'll be paid to you net of 20% tax, unfortunately. So that means you've got £1,000 worth of interest, less than £200 worth of tax, which would have to be paid to HMRC, and then you're left with this £800. And you're probably thinking, why on earth have I watched this stupid video if all he has done is told me, here's some tips, but then it doesn't work? Crazy, I'm switching off, unsubscribing. Well, please don't hang about, because what you can do on your self-assessment tax return, you can say, hey, I've got this £1,000 worth of income, which I want to receive, but I've been tax deducted at source this £200, and I want to reclaim that £200 on your self-assessment. And you could do that, so you get the money later on. Now, as a high rate taxpayer, clearly you've got this £1,000 worth of interest, you've had £200 deducted, but remember that £1,000 less the £500 interest-free or tax-free, I should say, income leaves you with £500 worth of interest that is taxable. £500 at 40% is £200, which basically works out the same. So you don't really have this issue. So you've paid this £1,000, you've paid the tax at source on the CT61, and all is fair game. So when does a CT61 form need to be done? Well, we've described that, but when does it need to be done is a matter of, well, a CT61 should be done in quarters, and therefore what I would suggest you do is wait until the annual year end of the company. So let's imagine that the company year end is 31st of March, whatever year. It will do a CT61, so it will understand, well, what is your loan that you've given to the company, £25,000. Let's do the interest rate based on the loan agreement that we've got outstanding here. And we will pay that interest over, less the 20% tax, and we'll do the CT61 form over to HMRC. So you could do that as part of the year-end process. And to be honest, that's what Optimize Accountants does for all of its clients now. We will do that CT61 form for you. But if you're doing it yourself, don't forget that you need to make sure that you pay the 20% tax to HMRC. You need to fill in the CT61. Now, this CT61 form normally needs to be done quarterly, but because you're doing the payment one-off per year, then you only have to do one CT61 form return. Now, I have to say, I was getting tongue-tied by saying CT61 several times. CT61, CT61, CT61. So that's how you can get money out of a limited company, tax-free. So has this video been useful? In fact, have you been taking interest out of your limited company before? If you have, then please do type in yes in the comments box below. If you have not been taking any interest out of the company before, please type in no. And has this video helped you understand how you can extract even more money out of the limited company? Don't forget, a couple of things here. If you want to learn how to extract more money out of a limited company, make sure you watch the video that we said at the beginning of this video. And we've also got Monday Night Live on 7 p.m. where I will be hosting a live session with you guys for property investing questions, property tax questions, and I'll be answering those on that session. So I look forward to seeing you there.